Hi guys, today we'll look at the risk management, which is your section G of the ACCA FM syllabus. Remember, there are 7 sections. We have the FM function, which is section A. We have FM environment, that is section B. Then we have working capital management, that's section C. Section D is investment appraisal. And section E is business finance. F is business valuation. And the last one is G, which is risk management. Out of all of this, we've dealt with this, we've dealt with this, we've dealt with this, we've dealt with this. We're done with this as well. Now I want to deal with this, and we'll be left with this after. And that will be it for FM paper. Right, so today we start a different section, which is section G. Very important, arguably most difficult part of this paper. And the way I'm going to take it in a very, very nice way that you'll be able to even teach AFM students and even CFA students if you pay attention to these videos. Right, so I will really implore you to pay good attention, and we'll go into it straight away. So we'll look at risk. That's what we're starting now, risk. And the way I want us to go over it, when we're talking of risk in this sense, we're talking of finance risk. So I'm going to give you a view of finance risk quickly. Then why do we need to do risk management, and how do we manage our risk? How? Yeah. So we'll look at how, why, and we'll also get an understanding. But I can tell you why straight away now. Why is because we want to minimize our loss. That's the major reason why that's why we manage risk. Minimize the impact of that risk as much as possible. But let's get into it. So just a quick introduction. So let's look at it. We need to understand what we're even talking about, because you've heard about risks in so many instances and you might be confused. What type are we talking about? First of all, what is finance risk? Because we said the type of risk we're talking about is finance risk. And what is finance risk? Finance risk is just the likelihood of losing money. It's a possibility or the likelihood of what? Losing money. It's as simple as that. In whatever you do in finance, what you're trying to do is to make money. However, as you're trying to make money, you need to put in money. So there's a likelihood that the money you are putting in, you might not get it back, or you might not get everything, or you might even lose everything. So usually finance risk is divided into 3 major parts. There are other subcomponents like operational and legal. We're not going into that. There are 3 major classes of finance risk. The first one is liquidity. The second one is market risk. And the third one is a credit risk. You've heard about all these types of risk. Liquidity risk is that likelihood that you don't have enough cash to fulfill your obligation, and that is why we were taught working capital management in section C of the syllabus. Right? Credit risk is the risk that your debtors will not pay you back. Likewise, working capital management touch on it, and cost of capital is also involved in that. So in this part of this syllabus, we are not looking at liquidity risk, we are not looking at credit risk. Our focus is on market risk. Right. For the guys who are also doing financial reporting paper, you probably have gone through this part in your IFRS 7. So this is also a good revision for you. In the theoretical part. Now, the market risk. The market risk is now also divided into 3 types. based on what is causing the risk. The first one is the price risk, which is the risk that you will lose money because of changes in price. There is foreign currency risk, which is the risk that you lose money because of the changes in exchange rate. And the third one is the interest rates risk, which is the risk that you lose money because of changes in interest rate. Ladies and gentlemen, once again, in this paper we are not looking at price risk, and we shall be focusing on these two types of risk. Now, I had to bring you down to this point so that you know what we're talking about, and I don't want you to get confused at all, because everything must be crystal clear to you. After this recording, all the videos for risk management from me, you must be able to dissect risk to anybody, especially finance risk. So no confusion. If you're lucky you have a question on risk, I know a lot of students pray that this question doesn't come out, but with these videos you would rather be praying that it comes out, because you will be a superstar. So now, these are the two that the paper wants us to focus on: foreign currency risk and interest rate risk. And let's start with foreign currency risk. And I've told you the meaning. The foreign currency risk is the risk, the potential possibility, of losing money. Remember, that is finance risk. But now we're talking of FX risk. Because if FX risk, now the possibility of losing money because of fluctuation in foreign exchange rates. Why? As a result of trades, or investment across different countries. That is settled in future. So you can see in this definition 3 things are involved. First is fluctuation of exchange rate. The second one is different countries are involved, and the third one is there's a future, there's a delay involved, future, so there's a delay. So that time delay is very crucial, because that is the reason why you are exposed. Pay attention, please. Pay a very good attention. Fluctuation, we won't be talking of fluctuation if there is no time, because fluctuation is not just one point. It means you are watching something, take for instance, for like 10 days. Day 1, day 2, day 3, day 4. And there's things that are moving. So fluctuation is because you are talking of time delay. For instance, I'm in London, UK. I'm doing my business in pounds. Now I'm owing someone in the US in dollars. If that person gives me money today and I'm going to pay him back in 3 months' time, for the next 3 months when I'm going to pay him back, exchange rate will not remain the same, and it will be changing. It might go in my favor, it might go against me, but there is fluctuation. And the possibility of it going against me is FX risk. Right. Now, you need to know the 3 types of FX risk. There are 3 types. And you are required to know the differences between the 3. The first one is your transaction risk. The second one is translation. And the third one is economic risk. And I'll tell you the difference between the 3, because there are 3 different things entirely. And the way you need to understand them is the causes. So you need to know what causes or what is the source of that risk. That's how you need to know it. Because when it's been tested as well, that's what your examiner will look at for your answer. So what causes transaction risk? Let me tell you the meaning first, then I'll tell you what causes it. Yeah. So transaction risk is as a result, is still the same definition that we have talking about, is a possibility of losing money because of fluctuation in exchange rate as a result of trades across different countries. Yeah. But now, what type of trade are we talking about? Here, we are talking of as a result of buying and selling in foreign currency. So buying and selling in FX, foreign currency. Yeah? Or as a result of borrowing or lending. Let me use or instead of and so that you don't get confused. It's not like you have to have the two to be exposed. Once you have either of the two, you are exposed. Right? In FX. So if you reside in the UK and you buy a product in the US, if you don't pay immediately, you are exposed. If you are able to pay immediately, you are not exposed because there is no delay. Remember, if you pay immediately, there is no time gap, so there is no exposure. But the fact that in finance, the assumption is always like when you buy and sell, it's always on credit. So you pay in the future 30 days, 20 days, 60 days. So there is a time gap where you need to watch the rates. Yeah, that's the cause. But translation is different. Translation is just as a result of monthly revaluation. I'm going to explain this one a bit differently. It's as a result of monthly revaluation of foreign currency denominated balances, whether it's asset or liability. Yeah. So let me quickly explain this. For reporting guys, you might easily understand this. And let me just explain even if you're not doing reporting. Every financial statement must be prepared in a presentation currency, right? Which is also called your reporting currency. Take for instance, if you're let's use UK because this is ACC, I'll be using UK a lot, right? And the currency in the UK is pounds. A company in the UK will most likely be preparing financial statement in pounds as the presentation currency, right? However, it is also possible that it's buying products or buying his inventory in a foreign currency from the US, which means in dollars, or he has a fixed asset, or he has a payable or receivable in dollar amount. Whoever we are owing in the US, we always know that we are owing him in dollars and we have that liability in dollars. In financial reporting, at every reporting period, which is usually every month, end of the month, one of the key activities that a financial reporting staff must do in accounting department, is to ensure that all those foreign currency denomination are translated to reporting currency because they need to prepare financials or management account every month or quarterly. So you need to know what that foreign currency will be in your translation currency, right? So that is just a reporting problem, and that is why we will not be looking at it in detail. But you still need to understand the meaning. So this one, I call it a financial reporting. It's not a financial management problem. This is a financial reporting issue. And you need to know that. It's financial reporting. It is not financial management. Right? And also, you should know that there is no cash flow implication. Because it's just revaluation. We're just revaluing our foreign currency based on the current exchange rate for reporting purpose. And that is translation risk. So this is for reporting purpose. This is for financial management. The economic one is our exposure because of our investment in subsidiary in another country. So this is because of foreign subsidiary. So we're exposed to that country risk. So We're not going to be focusing on this. You just need to know the meaning. This is our focus. Transaction rather, sorry. Transaction foreign exchange risk. Please take note. So that is what we'll be looking at. Yeah. And why do we have transaction foreign exchange risk? Well, remember I said this is our focus. Why are we exposed? I've told you we are exposed because of fluctuation. And fluctuation of what? Fluctuation of FX rate. Because this guy is always fluctuating. So because it's always fluctuating, that means we cannot fold our hands. And this guy is now a big deal that we need to pay attention on. So let's talk a bit on exchange rate. Let me give you a bit of understanding of exchange rate because you can be tested as well. So like I said, exchange rate is simply the price of a currency. That's the way a currency is being priced. See it like that. Take for instance, if I say, look at this exchange rate, $1.4/pound. What I'm saying here is that £1 will cost you $1.4. So the price of £1 is $1.4. So a way of pricing one currency against the other one is the exchange rate. So which means governments are highly involved because every government has an objective. And what is the objective of any government? The objective of any government is to ensure that they have a very strong exchange rate. Strong exchange rate. That is what every country wants to achieve. Yeah. And if you look at the whole of this world, it's discovered that Kuwait has a very high exchange. I think Kuwait has the strongest currency in the world. Yeah. UK is also strong. US is strong. But a lot of countries have strong exchange rate, and every country wants to have that. Nobody wants to have a very weak, though unfortunately it's inevitable. Some countries will still have very weak exchange rate. Yeah, and we'll start getting into why those exchange rates are weak like that. Right. So, but why is exchange rate different across the countries? Why is it not the same? So the cause of fluctuation. Why every country wants to achieve this, but every country cannot achieve it. Why? Because there is a fluctuation. Why is there a fluctuation? It's because of your forces of supply and demand. And that takes you quickly to your economic class. Because I've told you that exchange rate is called exchange rate, but it's also a price. It's a price. It's just not called a price of currency, but the meaning is that it's the price of currency. And if you remember you're in economics, price is driven by forces of supply and demand. So the same thing is applicable in exchange rate. So the forces of supply and demand in the law of demand and supply, if you remember, says that the higher the demand, the higher the price. And the higher the supply, the lower the price. The same thing is applicable in currency. If everybody wants a particular country's currency, the price of that currency will go up, which means that currency will appreciate. But if everybody is selling that currency, which means everybody is just supplying it into the market, everybody is selling it, nobody wants it, that currency will have a very low price, and that means the rate of that currency will be weak. It's the same principle. And because of that, every government wants to manage their exchange rate. every government wants to manage their exchange rate. And that would lead me to how do they do it? 3 ways they do it. The first method is the use fixed method. I will explain the difference. The second one is the floating method. And the third one is the managed approach. And just as the name implies, it's not difficult. Fixed method is just that the government try to fix the rate. They fix the rate by themselves, and they defend it with FX reserve. I'll tell you what that means. Remember I said that whether you like it or not, forces of demand and supply will control price, right? So some government will do if they are doing fixed. Usually no government does this because it's extremely difficult. Take for instance, if UK government says we want our exchange rate to stay at $1.4 for every pound, and we don't want it to be lower than that. We want it to be equal to that. What it means is that even when the forces of demand and supply wants to make these guys to fluctuate, take for instance, people are selling pounds too much, and this is meant to say come down. If they are selling pounds too much, then you expect the rates to want to come down because of the sale of pounds. So UK government will not fold their hands and be looking at that. What they do is they go to their FX reserve, say this is dollar now. So we need to go to every country has their foreign currency reserve. So you go to their dollar reserve and they start selling dollar and buying back their pounds to normalize the rate. That will just to cancel the effect of people selling pounds. They reverse it by doing the opposite, buying pounds with their foreign currency, which is dollar reserve. So now it now appears as if someone is selling a lot of dollar, and dollar also will start getting weak, and they can get this stable 1.4. So that is how to do fixed. So it's a difficult thing to do, and most countries will not do that. That is fixed. Floating is you just leave it to market, which means you leave it to for the forces of demand. So forces of demand determines the exchange rate. This one also is dangerous because if you leave it to the forces of demand alone, then your exchange rate can go super weak or also even super too strong that people cannot afford to buy things from your country. Right. So the best approach you will see is the managed approach, and that is a combination of fixed and floating. Some people call it managed floating or managed method. Yeah, what this means is that every country tries to fix, and sometimes they allow it to float. If it's getting too bad or out of hands, in the hands of forces of demand and supply, then they fix again. They try to defend with reserve again. So that is where they manage FX rate by any country.